Continuing with section 133 of topic 2, paper 12 on diversification, we will now consider the efficient frontier, a concept developed by Harry Markowitz in the 1950s. Now, the efficient frontier brings together portfolio return and portfolio risk, and we're looking for different combinations of investments within a portfolio that will maximize return and minimize risk. Now, we've just been given the line, the efficient frontier, at the end of that process. But what Markowitz did, he actually did it with two asset portfolios. He would change the elements within the portfolio, the proportion of one investment to the other, until he got the maximum return and the minimum risk for that combination. Now, we take that further conceptually, and we do it with a whole basket of investments within a portfolio. And conceptually, we keep on changing the proportions until we can get no more increase in the portfolio return and no decrease in the risk. And what you're left with is the extreme of the different combinations, and that is the efficient frontier. And you can see that B to C, that represents the inefficient aspect, because an investor is always going to go for a combination of investments with the higher return, that is above B, rather than below B on that efficient frontier. Now, we add to that the concept of indifference curves. Now, indifference curves is just a way of expressing investors' preferences. If you have a preference for low risk, then you are going to have what we say is flat, shallow indifference curves. And if you are happy with high risk, then you're going to have the opposite. So as we see there, high risk aversion means I don't like high risk. So I want a low risk and I'm willing to take a lower return. Whereas if I have low risk aversion, that is to say, I don't mind risk, just for a little bit more return, I'll take higher risk and I'm looking for a higher return. So it's a way of just putting together this idea of different investors have different risk aversion, different ideas of risk, their preference for risk. And so they will be at different parts of the indifference curve. So, as it says in the notes there, the optimal portfolio for each investor is the highest indifference curve. So you could go up the indifference curves that is tangential to the efficient frontier. And that the idea theoretically, that is the investable portfolio with the highest utility. And a more risk averse investor, going to the left of the diagram, may have portfolio A as his optimal portfolio, whereas the less risk averse investor can take on more risk, looking for the higher return, more likely to be portfolio B. Now, the choice between these optimal portfolios ultimately depend on the investor's risk return appetite. And in reality, you're not going to sit down and draw indifference curves. You're going to question the client and you're going to find out what is their appetite for risk. And if they don't like the concept of losing money, low risk, you will be going to the left-hand end of the efficient frontier. And if they're really hungry, they want return and they're willing to take on risk, then you will be moving to the right of the efficient frontier. Risk positioning, that's a process of selecting assets that will yield highest return for a stated level of risk. So this is putting into normal language what we've been showing in the diagram. The investment strategy may be constrained by maximum weightings for investments in each asset class, and that's certainly the case with, say, collective investment schemes. The gearing policy of the investor, whether or not they wish to borrow money, derivatives policy, the use of options, futures, for example, and how comfortable investors are with foreign exchange exposure. Okay, let's move on to section 1.4, and this is the last part on identifying clients' investment objectives and constraints. And 2 sections. We're going to look at KYC requirements and suitability requirements. So we've had a little bit of a deep dive into the theory, portfolio theory. Now we're coming back up and just looking at process of dealing with clients when advising them and indeed managing their money. Now, KYC requirements, they are a requirement of the code of conduct, the mother code of conduct for persons licensed by, registered with the SFC. Now, an asset manager or a fund distributor, type 1 license, should establish a client's true and full identity. You need to know who they are, their financial situation or their strength, how much money they have, their investment experience, their investment objectives, and this is going to help you decide on the advice you're going to give. Now, before buying or selling, executing any transaction, the intermediary must establish the identity of the ultimate beneficial owner, the ultimate beneficiary that's responsible for the transaction. The exception is a collective investment scheme, because if you are buying or selling for a collective investment scheme, you do not have to go beyond that and find out who the contributors are to the scheme. The identity of the scheme is good enough. Now, recommendations you make to clients should be suitable, and we'll look at that in more detail in the next section. When a client without knowledge of derivatives wishes to invest in derivatives, then the risks of such products should be explained to the client. When opening an account with a new client, it's preferred to be face-to-face as a way to verify the identity. Now, if that face-to-face meeting is not possible, the document should be certified by appropriate persons, and they give us the examples of a licensed person, justice of the peace, bank manager, accountant, lawyer, notary. And proper records should be kept of the procedures that are followed. Now, I said earlier that recommendations to clients should be suitable for their circumstance. Here's some more on that, the suitability requirement. And again, as per the code of conduct, you must make sure that any recommendation or solicitation for the client is suitable for their situation. Now, the obligations include knowing who your client is, going through the KYC procedure. Product due diligence. The asset manager or the fund distributor should fully understand the product that is being recommended to the client. Suitability assessment. Asset managers, fund distributors should match the risk return profile of a product to the personal circumstances and needs of a client. So if a client has short-term liquidity needs, you should not be tying up all his or her money in long-term investments. Information for clients, all relevant information with regard to an investment product should be provided to the client. With regard to competence and training, competent staff, goes without saying really, should be employed and provided with appropriate training. And the record retention, all information supporting the recommendation with regard to the product should be retained. So this is from the code of conduct, what you should be aware of when you are giving advice to clients. You should follow all these suitability obligations. And at the bottom of the page, we're told that from mid-2017, code of conduct requires a clause in any client agreement that the financial products listed for sale or recommended will be indeed suitable for the client. Okay, let's move on to section 2 under topic 2 of paper 12, and we're going to consider equities, fixed income securities, derivatives, and others. Now, 2.1 equities, well, over the long term, shares have historically outperformed other asset classes, although over the short term, often they underperform, depends on the stage of the economic cycle. Volatility of equity prices is indeed higher than other investment types. Now, what are the characteristics of equities? Easy to examine. They usually provide high returns, but over the long term, 5-10 years. They are volatile due to uncertain dividend cash flows and share price fluctuations. Well, the share price fluctuations in themselves provide volatility, but so does uncertainty with regard to the dividend cash flows in the future. With a company liquidation, you can lose your entire investment. Portfolio of equities is subject to both systematic and unsystematic risk. Now, these concepts are very, very important. Systematic risk is the risk of the whole market going down or up, the volatility of the market as a whole, whereas unsystematic risks are the unique risks relative to a particular investment. Shares have lower transaction costs, greater liquidity than direct investments. So it costs you less to buy shares in a property company than to buy underlying properties. Now, what do we have at our disposal to evaluate equities, to decide on the price we're willing to pay or whether or not they are a good investment? Well, fund managers analyze stocks quantitatively. And that's known as fundamental analysis, which we'll deal with later in the paper. And they have a number of models. We're going to look at 4. Now, be aware of these, very, very likely to be examined. We have dividend yield, and that shows level of income an investor can expect to receive from a share. Dividend per share, that is the dividend that's being paid now, divided by the share price. And historically, well, they're a function of interest rates, really. If interest rates are high, dividend yields, we're looking for high yields. Earnings per share, most quoted in the markets, and that's profit divided by the number of shares. But to be more specific, profit after tax less preference dividends, because the earnings per share is for the ordinary shareholders. So it's profit after tax less preference dividends divided by number of shares. Well, technically, it's the weighted average number of shares over a period of 1 year. Price earnings ratio, this is commonly quoted for companies and for markets. It's the multiple of current year earnings that must be paid to buy a share. So if the PE ratio is 10, that means you're having to pay 10 times 1 year's earnings to buy that share. A relatively high PE stock implies strong future earnings growth. It's referred to as a growth stock. So people are paying a high value compared to the underlying earnings. A relatively low PE stock, well, that means the price is low compared to the earnings. It can often be viewed as cheap and can be, not always, but can be referred to as a value stock. So it has value because we think the price will go up in the future. Now, historical PE ratio based on current earnings, the earnings that have just been or previously reported, whereas the prospective PE ratio, that's based on expected future earnings in possibly 1 year's time. So the PE ratio, market price per share divided by earnings per share. You must know that for the exam. And then the fourth method of evaluating equities, and this is where an important aspect is the underlying assets of the company, insurance companies, banks, for example, shows market premium above a stock's net book value. Now, high price to book indicates high growth opportunity. So people are paying a lot of money for the underlying assets, and they think that, well, earnings are going to increase and the price will rise in the future. So 4 ways of evaluating equities: dividend yield, earnings per share, price earnings ratio, and price to net book value. Please be aware of those for the exam. At least one, if not more, will be examined.